Hi, my name is Christoph Gleich. I'm the president and the CIO of Harbor Capital Advisors.
Hi, everybody. I'm Spencer Lerner, head of multi-asset solutions at Harbor Capital Advisors.
Welcome to another episode of Views from the Harbor. Welcome to our first Views from the Harbor for 2023. Given the timing, it's middle of January, we thought we would share our 2023 outlook. So I'm joined by Spencer Lerner, he's our head of multi-asset, and we're going to talk through everything that you need to know for the coming year. So Spencer, I think 2022 was best remembered about getting the inflation call right in the marketplace. We had this inflationary shock. We had a dramatic repricing of money, and cost of capital became a thing again after not really mattering for about 10 years post-financial crisis.
Right.
What does that mean for 2023? You know, what's the big call that investors need to get right this year? I think there was some debate earlier last year as how serious the Fed was in fighting inflation, and they haven't blinked so far. We've seen more quicker and faster and dramatic interest rate hikes that we've seen in a generation. So where are we now? What are we looking out for as it pertains to the economic outlook, the earnings outlook, the inflationary outlook? Are we going to avoid the dreaded R, the recession, with a soft landing, or is a recession all but baked in now? So why don't we jump in the asset allocation viewpoint deck, and you can find the link below to take you to this, and it's free to download. It's available and updated externally once a quarter. So Spencer, why don't you kick us off with some of our views and how we're positioned?
Yeah, I would love to. Thank you, Christoph. And we, just to kind of follow up on what you were saying, every quarter we have our quarterly investment symposium where our full investment team, about 20 individuals across Harbor, we get together and we kick the tires in our investment views in our institutional portfolios. And we invite our underlying sub-advisors at Harbor that manage our different funds to come in and give us their views and what they're seeing, as well as different third-party and outside strategists. So after our most recent investment symposium, we put together this 45-page deck, which we have, as Christoph said, you can follow the link. But let me walk you through some of our high-level thoughts for coming into 2023. And I'll start with the punchline in terms of positioning. So over 2022, we, for the most part of the year, really starting in February, March, we've been pretty bearish on risk assets overall. Our portfolios, our multi-asset portfolios, are, I would say, pretty underweight risk, and you can see that here in our tick chart, as we call it, on the right side of this page. This just lists all of sort of the core asset classes and sub-asset classes. If you can see my cursor, it's right here, and then we show from last quarter to this quarter that our changes in those positions, and then whether we recommend overweights or underweights or neutral, and each tick here across this horizontal axis at the top, you can think of that as reflecting about a 3% nominal position weight, so 3% overweight, 3% underweight, 6% underweight, etc. So in our aggregate portfolio, we're coming into 2023 and recommending an underweight to risk, and we would view that through the lens of beta or relative volatility, specifically driven by an underweight to equities, which we have listed here. We're generally underweight. I would say our largest underweights are in U.S. and particularly U.S. large cap. We're overweight Japan in local currency terms, and that's actually very important. So we want to be long the yen because we continue to see market pressures against the Bank of Japan and their yield curve control. And we're neutral emerging markets, but I have to say that I think probably the next incremental trade we're likely to make is to go overweight emerging markets. That's where we're starting to see some interesting opportunities. But net of all of that, we're underweight equities. In terms of equity styles, we remain overweight quality and low volatility. Just as we expect a downgrade to earnings over 2023. Christoph, as you mentioned, 2022 was the year of inflation and the liquidity shock, I would say, to markets, and we think 2023 is going to be a collapse in growth, which we'll talk through, and a drop in earnings, corporate earnings, which will affect both credit and equities alike. Within fixed income, although we were underweight duration for the better part of 2022, we're now overweight duration. And so we'd recommend kind of the midpoint of the curve being overweight, and particularly investment grade and MBS, where we can get a little extra yield relative to treasuries. But we do think 2023, we think bonds will again diversify equities, as we do expect sort of a looming growth shock to occur in the second half of this year, not the first half, in the second half. And I'll talk through kind of the portfolio strategy implications of that, because you want to be careful with your bet sizing and what you own if you think you're potentially 6 months out from a particular event or growth shock. And then as underweight credit, as I mentioned, we're sort of neutral. The US dollar, it's very possible it could continue to decline over the next few months, but we think we'll ultimately get a stronger dollar if and when a recession hits. And within commodities, we had overweight to precious metals, and in particular gold, which is something that we really like.
All right.
So
why don't we jump in to what's behind some of those views? Tell us what's going on. The economy seems to be hanging in there, and there's a bit of a debate at the moment between some of the sort of harder data versus the softer data. What are you seeing?
Yeah, it's you hit the nail on the head. That's I think probably one of the biggest questions in macro. And just for a little more color, so this is a 45-page slide deck. I'm just flipping through a bunch of it now. Again, follow the link, open the deck, go through all the details. We have commentary on every slide. We used to just release this to institutional subscribers, but we decided to, release this to anyone interested in reading the deck, learning more about our multi-asset team, and learning more about Harbor and everything we have to offer. So please feel free. What I'm just going to go through now are, in the beginning of the presentation, we have 3 slides with 12 charts, and that's sort of like a condensed summary of what we think are some of the key charts in the broader, deeper deck. So let me just take you through some of that and answer your question directly. So yeah, there's been a big divergence between what I'll refer to as hard data, or more concurrent data, data that tends to move in line with the business cycle at the same time as the business cycle, and then soft data, which I'll kind of refer to as being more leading, or data that's going to move months, quarters, and potentially up to a year and a half before the business cycle. And so we call those leading indicators. Now, we focus predominantly on leading indicators when we're trying to understand where the economy will be in the future, not where it is right now, because asset prices are discounting what's happening right now. We want to know, what do they need to discount in the future. So we have a business cycle index, or which we have for all the different regions globally, the major ones, China and emerging markets, Europe, Japan, the US, and we GDP weight all of those into a global business cycle index. And that's what we're looking at here in the top left. And this consists of each business cycle index for each region has about 30 different leading economic indicators. And those start to move down before the business cycle, or labor and various types of concurrent measures. Now, what's interesting is we have 3 different types of regimes in the way we view the world and we view the business cycle. We have a low risk expansion, a high risk expansion, and a contraction. And a low risk expansion just means the odds of a contraction in the next 12 months are quite low. A high risk expansion means the odds of a contraction in the next 12 months are quite high and above average. And a contraction means you're likely to be in an actual recession within the next few months. Now, this composite of about 30 leading indicators for each region, and there are 4 regions, so about 120 plus leading indicators, globally, actually moved into a contraction regime as of December. And the US and Europe also specifically moved into a contraction regime as of December. And those 2 business cycle indices have not moved into contraction. They've never had a false positive historically. They've preceded every single recession going back to the 70s.
So it's kind of a little bit like GDP, but it's more leading indicators of GDP and economic activity. So rather than just waiting for the data, this is looking at some of the stuff that kind of leads and forecasts where the economy is going, and that looks like it's pointing towards a contraction or a recession.
That's exactly right. That's exactly right. And so normally, when we move into a contraction regime, that suggests that the economy is actually, the global economy or the particular region is likely to enter a recession in the next 3 months. However, this time around, we actually think it's going to take longer. We think the lead of leading data is longer than it is on average. And the reason for that is because there's so much excess savings for the consumer in the US, also Europe, and also China, and that's supporting aggregate demand while overall nominal incomes are slowing. So, and I'll talk about that a little bit more in just a minute or two. But we think the lag is going to be a little bit longer than usual. But nevertheless, this is giving us a pretty clear indicator that growth is slowing pretty significantly. Now, in terms of what's driving that, we have a few different drivers of our business cycle index. We break it out into consumer and housing as a subcomposite, industrial manufacturing as another, and then monetary and financial conditions. Now, I think as we all know, monetary and financial conditions are very tight right now. Just look at the yield curve to tell you that, or money supply growth. And manufacturing and in the industrial side of the global economy is really slowing pretty aggressively, which we can see on the top right here, just looking at US manufacturing PMIs and the demand-oriented composites within the PMI, whether it's output, those are all really coming down pretty significantly and are below 50 now, indicating contraction. So while the manufacturing industrial side of the economy, which is a more cyclical part of the economy, and it's very driven by interest rates, the less cyclical and less interest rate sensitive part of the economy, which is driven by labor, so the services part of the economy, that's remaining much more resilient. We can see that in the bottom left. What we're looking at is the number of workers relative to the number of available jobs, and we can see that that is above 1, indicating that the demand for labor is greater than the supply of labor. That's what's driving wage growth, and that's what's really worrying the Fed. So manufacturing industrial side of the economy doing pretty awfully, as well as the construction and real estate side of the economy, also very interest rate sensitive. All the interest rate sensitive parts of the global economy are really struggling, but the labor market's doing really well. And continuing to do well. And so the question is the labor market going to move to the manufacturing side of the economy and slow, or is the manufacturing side of the economy going to improve and look more like the labor market? And what we would say is, if you go back and kind of study history, the manufacturing side of the economy is what leads the labor market, not the other way around. And the reason for that is because the manufacturing side of the economy is very sensitive to the strength in the dollar and currencies, and it's very sensitive to interest rates. And those are the things that reflect Fed tightening activity or central banks tightening activity. And that tends to be what moves first. That creates tightening financial conditions, that slows credit growth, that lowers asset prices, that reduces spending, and inevitably raises the unemployment rate. So the manufacturing.
Now, I've heard others say some of this softness in these leading indicators could actually be kind of an echo from the COVID supply chains kind of fixing themselves. For example, take a company like Nike. Let's say 6 months ago, it was taking them 90 days or 120 days to get new inventory. If they were ordering it, they're ordering very kind of far ahead. And then some of those supply chain issues are resolved, meaning that they no longer need to kind of order so far ahead, so they can kind of work their way through some inventory. So some kind of argue some of this softness is just kind of a result of some of the COVID supply chain stuff working its way through the system. Any credibility to that view?
There's definitely some credibility to the idea of there being very high inventories, both at the retailer and wholesaler level. And those elevated inventories for goods are leading to a reduction in pricing power. And that's part of the reason why we're seeing goods prices come down so quickly right now. So there is some credibility to that, but it's impossible to decipher how much of that is over ordering from COVID related trends and an actual softening demand. I think it's probably fair to say it's both.
Yeah.
But even regardless, even if it is both, having too much inventory still leads to having to cut prices, which leads to a reduction in profit margins, which has the same effect on corporate profitability. So there's probably some legitimacy there, but I'm not sure it changes our outlook all that much.
Got it.
And when you look at it, when you're kind of putting the mosaic together, the data points, what we're seeing is not just a couple data points that maybe are being altered by COVID trends. We're seeing a lot of different data points that are even fairly unrelated to COVID, such as lending standards tightening. And we think that, you know, when you bring it all together, it paints a pretty clear message. So
let's talk about the you mentioned lending standards tightening. Why are they tightening now? Like, how are they tightening? What's going on there?
Yeah. So this is a really important concept that tends to work through the economy pretty slowly, and so it oftentimes is not really. Oftentimes investors won't pay too much attention to it until it's almost too late. But so if we look at the top right chart here, now this is the primary mechanism through how, when the Fed or the central bank raises interest rates and increases the cost of money, how that ultimately works through the economy and slows down aggregate demand, and if there's too much tightening, leads to a recession. The way it's done is by slowing down credit growth. That's the primary mechanism. So if you think about the drivers of spending, right, and spending leads to profitability for businesses. So the drivers of spending are threefold. One is nominal incomes, right? So just hours worked times your average hourly wage and times your year-over-year growth rate in employment. The total amount of incomes all consumers are generating. That's that plus your net growth in credit. And I say net because at any given time, people are paying some principal, right? And then they're also taking out new debt. So you want the net of that to be positive, at least to get positive credit growth, which leads to more spending. And then the third part is savings. If savings are going up, then people are spending more than their incomes and credit would suggest. And if savings are going down, people are spending more than their incomes and credit would suggest. So those are the three drivers. Now, right now, what we're seeing is a pretty significant tightening in lending standards across banks in the U.S. We're seeing it globally, but particularly in the U.S. Now, on the top right, you can see the green dotted line. That's the Fed Senior Loan Survey percent of loan officers tightening lending standards. That means they're looking for higher quality borrowers because they're fearful that they won't get paid back their money because they're concerned about economic conditions in the bank's balance sheets. You can see that green line moves very closely with credit growth. That's the orange line, credit growth first trend. Now, the green line actually leads the orange line by 12 months. And so I have it leading here by 12 months. And so you can see the tightening of credit conditions really is going to feed into credit growth in 2023, probably closer to Q2, Q3. You're going to see a pretty significant decline in credit growth. And that's going to bring down aggregate spending pretty significantly and slow down aggregate demand in a big way.
Is it like a sort of three-legged stool? The first leg to go is credit growth, the most interest rate sensitive. The second leg of the stool to go is going to be the economy working its way through excess savings. And then the third leg of the stool, presumably if the Fed follows through, is going to be jobs. And so nominal incomes will go down as a result of unemployment going up.
That's exactly right. I like the three-legged stool analogy. I'm going to use that. So the first leg of the stool, credit growth, which we just went through. So we can see that the indicators of that are turning pretty hard. So now let's go to the second leg of the stool. And sorry for flipping the pages before. I was trying to find a different page, which I'm going to go to in a second. On the bottom right here, so now we're looking at nominal incomes like we were talking about before, right? Aggregate incomes of consumers in the U.S. Nominal incomes in the post-GFC era were running at about 4% per year. That's about in line with nominal GDP growth pretty consistently. In the post-COVID era, it skyrocketed to about 15%. That was driven largely by all of these fiscal stimulus measures and increased unemployment benefits that were creating transfer income, and incomes were growing at 15%. That's higher than any rate we've seen since 1971.
Yeah.
That's going back 50 years. The economy just couldn't handle that. That's a major reason why we're experiencing so much inflation. In 2021, that 15%, after all those transfer mechanisms came out of incomes and made their way into savings, that 15% nominal income growth rate dropped to about 9%. So that 9% nominal income growth rate, that was kind of what the economy was trending at. That nominal income rate usually runs pretty close to nominal GDP. Our economy can really only handle about 2% real growth and 2% inflation. It's about 4% nominal growth or nominal incomes. We were running at 9 for basically all of 2021. Running way too hot. Now, as a result of all of the tightening that we've been experiencing this year, what you're starting to see is the growth rate in employment has slowed significantly. Still positive job gains, but the rate of growth, year-over-year growth rate, has slowed significantly. And the hours worked per week for your average worker has dropped significantly. And by the way, hours worked tends to lead wages, and it tends to lead employment. That you're starting to see come down. So that 9% nominal income growth rate has dropped significantly and very quickly from 9% to about 6%. Now, 6% is still a very strong number, but it's slowing considerably and very quickly. So that second leg of the stool, nominal incomes, we're starting to see cracks form. So those are the two legs of the stool. And then the third leg of the stool, if I can just flip to this slide here, which is the excess savings like we were talking about. On the left-hand side, we just kind of walk through what that looked like. We got to that peak about $2.4 trillion in excess savings in the middle of 2021. Consumers have, ever since the energy shock of last year and the slowdown in nominal incomes, consumers have begun to pull down this excess savings. As of today, they're closer to a little bit over 1 trillion, maybe 1.2 trillion in excess savings. At the rate they've been pulling down savings over the last 6 months, we forecast that the consumer will have spent through all of their excess savings by Q3, Q4 of this year. So the three legs of the stool, savings, credit, and nominal incomes, are all showing cracks, and they're all showing deterioration, although it looks like there's going to be a little bit more runway until we really get a clear sign that all three are collapsing, and that's why we don't think it'll really happen until the middle to second half of this year. But all the evidence is pointing towards a pretty severe slowdown in those three drivers of spending. So why then, if that's sort of the backdrop, why is the Fed not, starting to cut interest rates? What's preventing them from doing so? We've had a couple really good inflation prints recently, but really the main driver of those inflation prints have been commodities and goods prices. And commodities and goods are very, very cyclical. And the way the Federal Reserve and the FOMC think about inflation is they're thinking about what's kind of the trend underlying rate of inflation. And the back of the envelope way to think about what that is wage growth minus productivity. And the wages minus productivity is kind of your trend inflation rate. And wages are growing between 5 and 6%. I know some are pointing to the average hourly earnings BLS metric that came out recently that had a 4.2% wage growth that looked much more attractive. But you have to be really careful with the average hourly earnings metric, because it's not adjusted for the mix, meaning they'll take new workers that weren't working a year ago and show you the year-over-year change in the median ratio. But if you have a mix shift in workers, that can drive your change in earnings. So really the gold standard is to look at the ECI, the Employment Cost Index, and the Atlanta Fed Wage Tracker. And both of those are running north of 5%. And the Fed really needs to see wage growth closer to like 3 to 3.5%, let's say 3.5%, to get comfortable that we're not going to be running with inflation above 2% longer term. And we're not seeing that right now with wages. And services inflation as a result, which we show here on the bottom left, even though goods inflation has rolled over and commodities have rolled over, and that's all a good thing, services is still running pretty hot, north of 4%. And I'll add to that leading indicators of rents appear to be rolling over. So we feel pretty confident that rents are likely going to roll over by the middle of this year. But the Fed is A, going to have to see that before they start cutting, and B, non-housing services makes up 55% of core PCE. So even outside of housing, we still need to see wages come down before the Fed would ever even consider cutting. So the realistic best case scenario is the Fed hikes to close to 5, slightly above, slightly below, let's just call it 5, and holds. And the only scenario we think that would cause the Fed to start cutting next year would actually be a scenario where the unemployment rate is meaningfully rising and growth is meaningfully slowing, aka the R word. We don't think the Fed's going to cut outside of that scenario.
So it seems like when you talk about the inflation picture, I'm going to use the word that's been banned, transitory. It seems like there's some transitory stuff there. Like the COVID happened, all of the fiscal stimulus, the various programs that were enacted. You saw on that chart you were showing, 15%, 9%, and now kind of 6%. It seems like those crazy kind of double-digit levels of nominal growth have gone, and so the transitory stuff has gone. But now we're kind of stuck with services inflation, even though kind of headline inflation has rolled over. We're still in a reasonably kind of uncomfortable spot from an inflation perspective, where services inflation is being driven by the secularly tight labor market. And at the moment, wages are still running nominally at about 5 or 6%, which is kind of not commensurate with a 2% inflation target. And so the Fed know this, they see this, they're going to let the credit leg of the stool go, credit growth will grow, excess savings will go, but then ultimately they're going to have to get some leverage within the employment market to bring down wages. And so there's anyone hoping for a pivot at the moment. It seems that really is kind of just a hope at the moment. Unless something dramatic from left field happens, it doesn't seem like there's a pivot on the near-term horizon anytime soon.
Yeah, a true pivot where the Fed is actually cutting the Fed funds rate and sort of unleashing liquidity into the system, that's an extremely unlikely scenario outside of a major growth slowdown. So it's possible we actually get the cuts that the market has priced for this year, but in order to get that, you have to get the commensurate growth slowdown in our view. Now, if we find ourselves in a situation where inflation miraculously comes back down to trend and the unemployment rate doesn't rise in 2023, in that scenario, we don't think the Fed is going to cut interest rates. The Fed will revise their view on what they think the neutral rate is. And they'll keep the Fed funds rate at 5% and they'll hold. And they might even actually hike further if the unemployment rate remains really, really tight and inflation gets to 2%, but it's, maybe it's driven by goods deflation and things like that, but wages are still too hot. They'll probably keep hiking even further. And that's, if the Fed goes to 6%, that's not a good outcome for risk assets either. So in those two scenarios,
let's talk about like what's priced in, okay? Because to monetize views, you have to be non-consensus and positioned against something that isn't priced into the markets. And Spencer, we've spoken now pretty consistently about 2022. Really, the reaction from risk assets was absorbing that greater discount rate and just renormalizing to a more normal cost of capital. And then the next sort of legs that tend to happen in a downturn are risk premia widens and earnings suffer as well. So where are we? What's being priced into markets at the moment? And let's touch upon earnings.
Yeah. Okay. So actually, let's start here. So the way we kind of view the world from a top-down perspective is through the lens of growth, liquidity, and inflation, and kind of the relationship, the circular, self-referential relationship between those three drivers. In terms of where we are with that cycle now, growth was just running far too hot in 2020, 2021. It led to inflation running too high. The Fed then starts to tighten liquidity conditions. That then slows growth to below trend, which then brings down inflation. So where we are right now is in the Fed is tightening liquidity and growth is slowing, but we're not at the point yet where the unemployment rate is rising and inflation on the wages services side is really durably coming down. We haven't handed that baton yet. So that's where we are and how we see things transpiring in terms of what we just talked about. Now, what about growth, liquidity, and inflation in terms of what the market's discounting? Because like you said, we want to look at the spread between what we expect on growth, liquidity, inflation, and what the market's discounting, and that's our source of alpha. Well, in terms of growth, what we like to look at are the S&P 500 dividend futures. So on this time series, these are the S&P 500 dividend futures for this year, for 2023. Now you can see in March, when we had the Ukraine-Russia war and the corresponding spike in energy prices, market expectations for dividend futures collapsed for 2023 by a significant margin, by about 16%. That's typically what you see in a recession, or if the market's pricing a recession. You then saw a bit of a recovery, and then you continued to see dividend futures come down again over the course of Q2, pretty close to their lows as energy prices remained high and the Fed continued to tighten and things like that. What we've seen more recently is dividend futures continue to get priced higher and really get close to their highs over the last 12 months. So what this is telling us is that markets are not pricing any sort of growth slowdown that will have any effect at all on earnings. So the market thinks that growth is going to be just great in 2023. Okay, so that's the growth side. What about the inflation side? On the left-hand side here, we're looking at the break-even inflation curve, interpolated. So what that means is we can take the next 10 years of inflation break-evens, which is the difference between nominal interest rates and tips or real rates, and that tells us what the market's discounting in terms of inflation. And we can break it out by the next 12 months, the 12 months after that, and then the 12 months after that, and then thereafter. And so we can kind of look at sequentially what the market is viewing for inflation. Now, the market's pricing in 1.7% inflation this year, below trend. And then thereafter, it's pricing in inflation a little bit north of 2. So this is sort of a Goldilocks inflationary type of scenario, right? This is the Fed can only dream of such an outcome. And then in terms of liquidity, if we look at the chart on the right, this is what the market's discounting for Fed rate hikes / cuts. And looking at the green line, the most recent line, the market assumes we get to a peak rate of about 5% in Q3 of this year, and then cuts pretty aggressively all the way down to about 3.5% by the end of 2024. So the market assumes that the Fed is going to be cutting interest rates this year, inflation is going to be running below trend this year, and growth is going to be ecstatic. It just seems to us that that's an extremely unlikely combination of events.
So the market is kind of unequivocal in that it's pricing in a soft landing. And so
the softest of landings, yeah.
The softest of soft landings, whether you look at it through the growth lens, whether you look at it through the liquidity lens, or whether it's through the inflation lens, everything is kind of pointing to this nice soft landing. And, that could happen. It's not a 0% probability. But in terms of, as an investor, you think in probabilities, you think where the market's priced in. And essentially the way that we see the world at the moment, we see growth deteriorating. We see the economy deteriorating. We see that most likely to happen in the back half of this year. And yet, to juxtapose that, what's priced into the market is a very benign kind of super Goldilocks soft landing. And ultimately, those two things are going to have to converge. And we think it will be the real economy that wins out.
Right. Most likely. In order to get this outcome of low inflation and the Fed cutting reasonably aggressively, in order to get those two things, you most likely have to get growth slowing pretty significantly and the unemployment rate rising. And in that scenario, dividend futures and earnings are going to be falling quite substantially, not rising and not at cycle peaks. And I could also tie that to our actual forecast for earnings, which, just going back to earlier in the deck on the bottom left, we also model out what we think earnings are going to look like over the next 12 months. And we have a statistical model where we incorporate leading indicators of earnings, and you can see on the left side here, the bottom left, the dotted line is trend earnings. You can see earnings kind of follow this log linear trend over time. And the actual earnings tend to go above trend and fall below trend and rise above trend and fall below, kind of like the economy. And the green line is our prediction of what earnings are likely to be given leading indicators. And you can see that earnings just shot up very far above trend, commensurate with growth, far above trend, as we talked about. Nominal incomes running at 15% at one point. Our forecast using leading indicators suggests that earnings is likely to fall quite significantly from here and get to at least trend. And historically, whenever you're above trend and you fall to trend, you usually then drop below trend, because that tends to be a pretty acute growth slowdown that requires Fed cuts to kind of reaccelerate the economy. So this outlook for earnings is really pretty unexciting, that we see a pretty significant downgrade cycle ahead. And downgrade cycles, they're usually pretty slow moving. They take time to play out, just as the economy is pretty slow moving in the credit cycle. But on the bottom right, when we incorporate our earnings expectations relative to where we think the 10-year is likely to be in a year, so if we think earnings, not in the next 12 months, but the second 12 months after that, are likely to be around 215 per share, and you compare that to consensus of 253, so meaningfully below consensus, and you think the 10-year is going to be around 2.5%, which is where we think we'll probably be in a year, just given the growth slowdown and the market price cuts, that would suggest that the S&P should be 15% lower than where it is today, using our equity risk premium model and our earnings forecast. So we're not getting paid at this point to own equities, considering what they're discounting, and high yield spreads just north of 400 basis points. We're not getting paid to own credit. We really think that you want to be a little bit more in capital preservation mode right now. But you also need to be considerate of the fact that, just going back to our tick chart, that this might take 6 to 9 months, maybe even 12 months to play out. Those excess savings are going to keep the economy going longer than it otherwise would have. So don't bet the farm right now. Don't be max underweight risk. Be sufficiently underweight risk that you're positioned for this outcome. But if markets rally at some point over the next 6 months, you want to be able to cut risk more, so you can ultimately make money on that bet. And the other thing I would add is you want to own things in the portfolio that will work potentially in the next 6 to 9 months if we don't get a recession right away. So in our view, there are actually a couple assets that interestingly work in a hard landing, but they also work in a soft landing. They sort of work in both of the tails. One of those is duration. So if we have that miraculous soft landing, it's because all of the inflation that we're seeing ended up being driven by COVID-related dynamics that no one expected, and it comes back down to 2 for the foreseeable future, and that allows the Fed potentially to cut. In that scenario, in that soft landing, we think long rates come down, so you get the duration benefit plus the 4% yield. So duration looks attractive in that scenario. The other asset is gold.
And bonds can play a bit more of their role that we were used to with protecting portfolios again. Spencer, yes. I know you can talk for days about the economies and the markets. We're going to close it out there. So thank you. Hopefully you've liked what you've heard. Again, look in the message below. The link is included. This presentation is free to download. If you want to reach out and hear from Spencer directly, contact your representative at Harbor Capital. You can also follow Spencer on Twitter. His handle is at Learner Spencer. Yeah. At Learner Spencer. Mine is at Gleish Christoph. And with that, Spencer, thank you. And thank you all for joining us for another episode of Views from the Harbor.
All right. Thank you. Take care.